Welcome to Crisis in Perception, where we examine the systems shaping our world, one book at a time.
Today we're doing a systems-level analysis of a truly monumental work in modern economic thought, Thomas Piketty's Capital in the 21st Century.
And this book is really driven by one single urgent question that has, haunted societies for centuries.
It is. The question is, why does wealth and income inequality not only persist, but actually tend to get worse over time, especially in advanced economies?
Okay, so let's unpack that.
Right.
Because we're not talking about, individual moral failings or just some short-sighted policy mistakes that we can patch up with a quick fix.
Not at all.
Piketty's whole premise reframes the debate. He argues that this dynamic of wealth accumulating at the top should be seen as a structural tendency. It's built into the system. It's the default setting.
Exactly. And so our mission today is to step back from the usual political noise and really analyze the mechanics that Piketty describes in his research.
This is all based on data, right?
Yeah. Centuries of painstakingly compiled historical data. The goal here is to reveal the long-term, self-perpetuating economic forces at work. So we're going to be focusing purely on the mathematics of accumulation, steering clear of any partisan interpretations, and just concentrating on the structural reality of how wealth behaves.
And that's what makes this work so powerful. It gives us the data to actually see the system rather than just, reacting to the outcome.
Precisely.
So let's start with the author himself and the sheer scope of this project. Thomas Piketty is known for taking an extremely long view.
He is. And it's important to know this book isn't just a reaction to the 2008 crisis. It's really the culmination of 15 years of dedicated research, from about 1998 to 2013, all focused on compiling and analyzing the historical patterns of wealth and income.
And he didn't do this alone, right? This is a huge undertaking.
Oh, a massive collaborative effort. It had to be. Initially, his work was more focused on French data, but it really gained this huge international scope through some crucial partnerships.
Like with Anthony Atkinson.
Yes, notably with Anthony Atkinson, who was a giant in the field. He was instrumental in compiling these extensive data volumes covering the British case, and eventually they had data for about 20 different countries.
That global perspective feels essential because capital itself is a global force.
It is. And crucially, he also worked with Emmanuel Saez, focusing specifically on the United States.
And that's where one of the most explosive findings came from, isn't it?
It is. That collaboration produced the data on what they called the vertiginous growth of the top 1%'s income share in the U.S.
Vertiginous, so just skyrocketing.
Skyrocketing, starting sharply in the 1970s and 80s. That single finding, that one graph, completely reshaped the public and political debate around the world.
So what sets his method apart? Why was this data so revolutionary?
It's the temporal and spatial breadth. He systematically went beyond the usual surveys. He dug into deep historical records, tax data, probate records, national accounts, and pushed the timeline as far back as the 18th century.
For key countries like France, Britain, the U.S., Germany.
Exactly. And the reason this long-run perspective was so essential is fascinating. Piketty argues that the underlying dynamics are so powerful that even 30 or 40 years of data isn't enough.
Why not?
Because certain shocks, he points specifically to the economic chaos of the two world wars, persisted for so long that they actually masked the underlying structural tendency toward inequality for almost 2 whole generations.
So we were living in what felt like a more equal time, but it was actually an anomaly.
We were living in an abnormal period of wealth compression without even realizing it. The system was just temporarily knocked off its default path.
So we have to see history as this long wave, not just a snapshot. The mid-20th century was the exception, not the rule.
That's the key. And to really appreciate his breakthrough, you have to understand the 2 major intellectual traditions he was wrestling with.
Okay.
First, you have the 19th century figure, Karl Marx. The Marxian question was whether capital accumulation would inevitably lead to this total concentration of wealth and then, the eventual collapse of society.
Right. The principle of infinite accumulation.
Exactly. Now, Marx's timing on the collapse prediction was, well, it was off. But Piketty gives him credit for the philosophical power of the argument.
He was writing in the middle of all this political turmoil without the kind of data we have now.
That's right. Marx assumed no durable technological progress, and he just lacked the detailed statistics. But Piketty argues that the core insight of that principle of infinite accumulation is still highly relevant today.
How so?
Well, Marx's logic suggests that if population and productivity growth are both low, then accumulated wealth, The sheer weight of the inherited past naturally becomes massively important compared to the income being generated by people who are alive and working.
So the dead hand of the past literally outweighs the efforts of the present.
In a way, yes. Accumulation may not lead to infinite concentration, but the equilibrium level can get so high that it becomes socially and democratically destabilizing.
And that's the link. Piketty is basically providing the mathematical proof for that 19th century anxiety. He shows that the incredibly high levels of private wealth we've seen in Europe and Japan since the 80s and 90s, it reflects that Marxian logic coming back into play.
It does. And then you have the 20th century counterargument, which was a much more comforting theory, the Kuznets curve.
Right, Simon Kuznets. This was the idea that as economies mature, inequality automatically peaks and then starts to decline. It's self-correcting.
It was a very optimistic, almost automatic view, and it became the dominant economic narrative for decades. But Piketty argues that Kuznets' finding, which was based on data largely from between 1913 and 1948, was a historical mirage.
A mirage created by those shocks you mentioned.
Exactly. It was an accidental data gap. And to be fair, Kuznets himself, writing in the 1950s, actually acknowledged that the income compression he was observing was largely accidental. He said it stemmed from the Great Depression and World War II, not from some natural automatic market dynamic.
But that nuance got lost over time.
It did. And Piketty takes the critique even further. He points to the context. Kuznets' optimistic theory came out during the Cold War. It was specifically intended to, in his words, keep underdeveloped countries within the orbit of the free world.
So it was an ideological tool?
It served a political purpose. It was a useful story to tell.
Yep.
Just stick with free markets and growth will naturally fix inequality.
Okay, so we've moved past the 19th century collapse prophecy and the 20th century harmony myth. So what is Piketty's core unifying thesis, the thing he pulls from all this data?
The central unifying thesis of the entire book is, it's actually incredibly simple but profound. It is this. Wealth concentrates naturally whenever the rate of return on capital, which he calls R, consistently and significantly exceeds the rate of economic growth, G.
R is greater than G.
R is greater than G. This simple dynamic fundamentally favors inherited wealth and passive accumulation, the rentier model over income earned from labor and effort.
That's the engine of divergence. Let's really spend some time making sure we get the mechanics of R and G. This feels like the absolute core of the book.
It is. Let's delve into why this equation is the prime driver of long-term inequality.
Okay.
Historically, Piketty finds that the real pre-tax rate of return on capital, R.
And just to be clear, R means the yield you get from a whole portfolio of assets, right? Land, real estate, stocks, bonds.
Exactly, the whole basket. After you account for inflation, that return has been remarkably stable and structurally high. It averages around 4 or 5% annually before taxes.
4 or 5%, like you said before, that doesn't sound huge on its own.
It doesn't, but the key is that it's a structural constant, held steady over centuries. Capital, by its nature, demands a yield. Now contrast that with the rate of economic growth, G, which is the annual increase in income or output for the whole country.
And that's where the gap opens up.
A huge gap, especially in the modern world. Once a country goes through its demographic transition, so population growth slows way down and it reaches the technological frontier, its growth rate, G, tends to slow down significantly.
So in advanced economies like Europe or the US, what are we talking about for long-term growth?
You're talking about G sinking towards 1% per year, maybe even less. And the structural gap consistently at 4 or 5% and G down at 1%, that is the engine.
Okay, let's use a concrete example to really feel the power of this gap.
Yeah.
Let's imagine two people. One is a highly skilled engineer, earns a good salary, say $100,000 a year from her labor.
Okay.
And the other person is an heir who just inherited $10 million in capital. Let's use your numbers. G, the economic growth, is 1%, and heir, the return on that capital, is 5%. What happens?
Okay, well, the engineer's salary will grow, but it's only going to grow roughly in line with the economy, with G. So maybe it goes up by, say, 2% a year if she gets a promotion. Her income grows slowly. The heir, on the other hand, sees their $10 million growing at 5%. In the very first year, that $10 million generates $500,000 in passive income.
5 times the engineer's entire salary without lifting a finger.
Exactly. And even if the heir decides to live lavishly and spends $100,000 to match the engineer's lifestyle, they're still reinvesting $400,000.
So their fortune isn't just huge, it's growing at 4%. which is 4 times faster than the entire economy.
Precisely. The passive accumulation from R is constantly recapitalized. The engineer has to work harder and harder just to try and keep pace with the automatic, passive growth of the capital owner's portfolio. It's a race she can't win.
So a fortune inherited from the past just grows faster than income you can earn from effort in the present.
That's the inexorable logic, and this leads to an ever-increasing concentration of wealth and income from capital over time. Piketty argues that these capital-dominated societies, the ones defined by hierarchies of inherited wealth, the world of 19th century authors like Balzac and Austen.
That whole world.
That world can only arise and sustain itself in these low-growth regimes where inherited capital is structurally dominant over labor.
Okay, that brings us to the second fundamental law he talks about, which maps this accumulation structurally. This is the one that determines how intensely capitalistic a society is.
Yes. The formula is a FRFIA-ILSG. Beta equals the savings rate divided by the growth rate.
And beta is the capital to income ratio.
Right. It's a crucial metric because it tells you how much wealth saturation there is in a society. Beta is simply the total stock of all capital in a country relative to its annual income.
So if a country has $6 trillion in capital and produces $1 trillion in income, the beta is 6, or 600%.
Exactly. And the law says that when the savings rate is high, meaning people are saving a big chunk of their income, and the growth rate, G, is low, the capital to income ratio, beta, becomes very high.
In simple terms, society becomes intensely capitalistic. You have this massive stock of accumulated, mostly private wealth from the past just sitting there, relative to the annual flow of income being produced by people working today.
The Belle Epoque pre-World War I Europe was the textbook example.
Yeah.
Wealth was 7 or 8 times national income. Beta was 700 or 800%.
Which brings us back to the great equalizer of the 20th century, because the massive reduction of inequality we saw between, say, 1910 and 1950.
Yeah.
You're saying it wasn't automatic, it wasn't harmonious.
It was a brutal, historical, and fundamentally non-economic rupture. The Great Depression and the 2 World Wars delivered a series of just extreme political and economic shocks that essentially wiped the slate clean for capital owners, especially the wealthiest ones.
He's really emphatic about this, isn't he? That this equality was a product of chaos, not conscious democratic design.
Absolutely. The sources outline 4 specific factors here, and they're worth detailing because they just show how extreme this interruption was.
Okay, what's the first?
First, just the physical destruction of capital. Factories, houses, infrastructure, literally blown up. Second, the collapse of foreign portfolios. Think about the immense colonial claims and foreign bonds held by Britain and France. They were decimated, either through nationalization, revolution, or simply being rendered worthless.
So those 2 factors alone, physical destruction and financial collapse, how much do they account for?
Together with low savings rates during wartime, they accounted for about 2/3 to 3/4 of the total drop in the capital-to-income ratio. A huge hit.
Wow. Okay, what was the third factor?
The third was a dramatic shift in the political context.
Yeah.
Post-World War II, you saw widespread nationalization and mixed ownership. Asset prices were kept artificially low by politically powerful post-war governments.
So the state stepped in.
In a big way. France, for instance, entered a period Piketty calls capitalism without capitalists, where public assets were very high in 1950, and the state controlled the largest firms in key sectors. This acted as a deliberate brake on private capital accumulation.
And the fourth factor is one we don't often think of as an equality tool: inflation and public debt.
It's a huge one. The very high inflation between 1913 and 1950, it was over 13% annually in France, effectively decimated nominal assets.
Especially things like bonds, which have a fixed value.
Exactly. It disproportionately hammered capital owners holding bonds. And more critically, high inflation was this major, if very crude, tool for reducing the real value of the massive public debts that countries ran up during the wars.
So governments basically inflated away their debt.
They did, and in doing so, they penalized the creditors, the capital owners, in the process. So you see, the compression of inequality wasn't achieved through some gradual democratic consensus or a technological miracle. It was chaos, destruction, and the political and monetary policies designed to cope with that chaos.
And Piketty's whole point is, this was an anomalous period.
A deeply anomalous period.
But that transitional period of Reconstruction capitalism, as you called it, was pretty short-lived. Since the 1970s and 80s, we've seen this dramatic, systematic rebound of capital.
A huge rebound. Private wealth in rich countries has soared from maybe 200 to 350% of national income in 1970, all the way up to 400 to 700% in 2010.
So we're right back, or at least approaching, those extreme Belle Epoque levels again.
We are, which proves that the structural force of RG was only suppressed. It was never eliminated.
And this comeback is just that second lot of TSG kicking back into gear.
Exactly. Slower economic growth, G, coupled with continued high savings rates, just mathematically drives the capital to income ratio, beta, back up. We are wealthy countries with low growth, therefore we are intensely capitalistic. It's that simple.
And then on top of that, you have asset prices catching up after being suppressed for decades.
Right. And all of this means that the structural importance of inherited wealth is returning with a vengeance, creating what Piketty explicitly calls a patrimonial society.
A society where your wealth is determined more by who your parents were by the past than by what you earn today.
That's the definition. And we can track this through the data on inheritance flows.
What does that show?
The annual flow of wealth from inheritance collapsed from about 20 to 25% of national income before World War I down to just 4 or 5% in the 1950s.
A massive drop.
But Piketty projects that it will return to those high historical levels, upwards of 20% of national income by the end of this century. And the crucial detail is that even today, inherited wealth already accounts for the vast majority, 80 to 90% of all private wealth in these hyper-patrimonial societies.
So most of the wealth out there wasn't earned by the person who has it.
Largely no. The desire to perpetuate the family fortune, Piketty notes, plays a central role in accumulation. It often dominates the simple motive of saving for your own retirement. We're not just accumulating to consume later, we're accumulating to ensure the family dynasty survives.
It's a return to the structure of 19th century society, but with, smartphones and the internet. And that structural reality is a chilling challenge to our whole myth of meritocracy.
It is. But while capital inequality, the RG mechanism, is the main long-term driver, Piketty also has to explain the huge surge in income inequality we've seen, especially in the U.S. since the 1980s.
Right, because inequality of capital is always way more extreme than inequality of labor income.
Always. The bottom 50% of the population might own almost no wealth, less than 10%, but they still claim, 25 to 33% of all labor income.
So even if you have no assets, you still have your paycheck. But the nature of income inequality has fundamentally changed since the post-war era.
It has. In the U.S., the main thing driving rising income inequality after 1980, pushing the top decile share back up to 35 or 50%, is the explosion of very high labor incomes.
We're talking about the rise of the supermanagers.
That's the term he uses. This group top executives, financial traders, maybe some superstar professionals, they make up the very top of the wage distribution, the top 1% or even the top 0.1%.
What kind of income are we talking about here?
In 2010, the threshold for that top 1% started around $352,000 a year. And their compensation packages are historically unprecedented. Massive bonuses, stock options, deferred comp.
Now, the standard economic defense for this kind of extreme pay is the race between education and technology theory, right?
Yes, the idea that globalization and new technology have increased the marginal productivity of uniquely skilled people, and so companies are just forced to pay these huge market rates to attract global talent.
But Piketty finds that argument pretty shaky.
He finds it deeply insufficient. He points out that the U.S. economy was arguably more dynamic and innovative between 1950 and 1970, during the post-war boom. Yet top executive pay was highly compressed back then. It was nowhere near today's levels.
So why the difference? If it's not just productivity, what is it?
Well, Piketty argues it's because the rapid rise in supermanager pay is just incredibly difficult to explain purely by marginal productivity. I mean, how do you objectively measure the unique contribution of one CEO in a giant multinational corporation?
You can't, really.
The answer is it's almost impossible. And this is where we really hit the crisis in perception. The smoking gun is the divergence between the U.S. and other advanced economies like continental Europe or Japan.
They all experienced the same technological changes in globalization.
They did. But the growth of top incomes there was significantly less severe. And this strongly suggests that it's not just about economics. It's about institutional differences and, crucially, changing social norms about what counts as fair remuneration.
So it's about what we as a society decide is an acceptable amount for someone at the top to make.
Absolutely. Executive pay is often set by compensation committees, which are made up of their peers, other executives with similar backgrounds, and paid expectations. Once the social norms shift, maybe influenced by a rising ideology that favors minimizing taxes and regulation, the institutional checks that used to cap pay just dissolve.
So the supermanager phenomenon is as much a political and cultural story as an economic one. It's a self-justifying cycle.
It's a self-perpetuating cycle of social justification for extreme wealth accumulation.
Okay, this is a good point to zoom out and actually map the system that Piketty is describing, where all these mechanisms play out.
Let's do it. So the key actors are pretty clear. You have capital owners, the rentiers, corporations, foundations, billionaires. You have workers who are primarily dependent on labor income. And then you have governments and institutions that regulate the whole thing, like tax authorities and central banks.
And the definition of capital itself is really critical here.
It is. Piketty defines capital or wealth very broadly. Land, housing, machinery, intellectual property, financial assets, all of it. But and this is vital, his definition of capital excludes human capital.
Meaning your education, your skills, your future earning power. Why does he exclude that?
Because unlike a piece of land or a stock portfolio, you can't legally sell your human capital on a market, and you can't pass it down to your children through inheritance. This distinction is absolutely key to understanding the structural advantage of inherited non-human capital.
And when you look at the balance sheet of a whole nation, it reveals this huge shift has taken place. National wealth is just private wealth plus public wealth.
And the defining and frankly disturbing feature of developed countries today is that public wealth is basically insignificant or even negative.
What do you mean negative?
In many countries, including the US and UK, public debt is greater than all public assets combined. The government owns less than it owes.
And the system has actively worked to shift that balance since the 70s.
It has. The sharp increase in private wealth was significantly amplified by the transfer of public wealth into private hands through privatization. And this wasn't just selling off assets. Piketty notes this often happened at notoriously low prices. It was a clear transfer of value from the public ledger to the private one.
A great deal for the buyers. We saw a lot of that in Britain in the 80s and 90s.
We did. And on top of that, government behavior contributed. In all rich countries, public dissaving, that's when government deficits are bigger than public investment, accounted for a huge chunk, maybe 10 to 25%, of the increase in private wealth between 1970 and 2010.
So it's like a family deciding to spend its savings and cash out its home equity just to cover daily consumption. It directly facilitates the growth of private capital by shedding public assets and taking on public debt.
That's a great analogy.
So what are the incentives driving this? Why do people accumulate wealth if, for most people, the primary driver of income is labor?
Piketty identifies the core incentive as perpetual accumulation. It's for increased future consumption, sure, but also for security, for prestige, and most powerfully for perpetuating the family fortune.
The RG dynamic makes that the logical thing to do.
It ensures that gold dominates any simple motive of just saving for your own retirement. If your capital grows automatically at a high rate, the incentive to preserve it and expand it for the next generation is overwhelming.
And to justify the extreme divergence this causes, especially in societies that call themselves democratic, you need a really sophisticated story, a narrative.
You do. And modern high-inequality societies, especially the U.S., often describe themselves as hyper-meritocratic societies of superstars.
The narrative that says these astronomical inequalities of wealth and income are justified because they're based on pure merit, effort, and unique talent.
And Piketty finds this narrative particularly potent because, compared to the open patrimonialism of the past, where everyone knew the Duke was rich because he inherited all the land, this new narrative is, in his words, much harder on the losers.
That's a crucial psychological point.
Yeah.
If you're told society is a pure meritocracy and you fail to get rich, the system tells you that failure is entirely your own fault.
It's a personal failing, a lack of merit or not enough productivity. It's not a structural limitation of the system, and that legitimizes the whole structure and keeps the status quo in place.
This narrative shift is also clear in just the words we use, the rentier narrative shift.
Yes. The words rent and rentier became very negative in the 20th century. They became synonymous with some kind of market imperfection, a monopoly, or just passive, undeserved extraction.
But Piketty wants us to strip away that moralizing language.
He does. He wants us to confront the cold economic truth. The high income yielded by capital rent, interest, dividends is not a market imperfection. It is not a monopoly problem.
Wait, so you're saying the inequality from RG is not a sign that the market is failing?
Precisely. In fact, it is the natural, logical, inevitable consequence of a pure and perfect capital market, where R is greater than G.
The market is working exactly as intended.
It is. If capital is privately owned and growth is slow, the market functions perfectly by rewarding capital at 4 or 5%, and that 4 or 5% structurally outpaces the 1% growth of the economy. The logical contradiction that capital yields substantial income without requiring labor is a fundamental reality of private ownership in a low-growth market economy.
So the problem isn't market failure. The problem is market success in a low-growth world.
That's the unsettling conclusion. And this concentration of wealth creates these powerful, self-reinforcing feedback loops.
Right. When wealth concentrates, it gains the power to influence the rules of the game. Piketty calls this policy capture.
Wealth enables further wealth concentration. A key mechanism here is just financial opacity. The more concentrated capital income becomes, the easier it is to hide in global tax havens through fictitious financial flows and complex legal structures. It makes democratic oversight almost impossible.
And we see this political power most clearly in the history of taxation.
Absolutely. The reversal on taxation. Progressive taxation with those extremely high top marginal rates, 70, 80, even 90% in the US, Britain, and France from the 40s to the 80s, was a direct consequence of the extraordinary chaos of the world wars.
It wasn't, as Piketty sees, a natural outcome of democracy just choosing high taxes. It was a response to an acute crisis.
That context is everything. Because when the crisis faded, the capital-owning class successfully lobbied for a massive taxation reversal after 1980.
In the U.S., the top marginal income tax rate fell from 70% to just 28% in 1988.
And that policy change, combined with the shift in social norms we talked about, led directly to the explosion of supermanager incomes and the overall rise in capital accumulation.
And what does the data say about the argument that cutting taxes on the rich spurs growth for everyone?
The data is clear. This dramatic reduction in taxation for the wealthy was not statistically associated with higher rates of economic growth. The argument that high taxes stifle growth simply doesn't hold up when you compare the high-tax, high-growth 1950s and 60s with the low-tax, lower-growth period after 1980.
So the tax cuts primarily redistributed income upward. They didn't grow the whole pie faster.
That's what the data suggests. And what's more, the system has another built-in mechanism that rewards scale and accelerates this divergence: the power of large fortunes.
I'm talking about the biggest of the big. Billionaires, massive university endowments.
Exactly. And these fortunes often achieve structural rates of return that are significantly higher than what a normal investor gets. They might get 6 to 10% annually versus the average 4 to 5% for smaller investors.
Why do the biggest pots of money grow faster?
Two main reasons. First, economies of scale in portfolio management. If you're a billionaire, you can afford the absolute best, most specialized investment managers. You get access to unique funds and complex, long-term strategies that are just unavailable to a regular person.
And the second reason.
And this is more important. They have the ability to reinvest nearly all of their income. If you're managing a $50 billion fortune, you can live a magnificent life off just 1% of the annual return and still reinvest the other 9%.
Which just dramatically amplifies the core RG dynamic.
It puts it on steroids. The largest fortunes grow faster for structural reasons. They are mathematically destined to outpace everyone else, leading to extreme concentration within just a few decades.
Let's connect these abstract concepts back to the concrete reality for an average person, especially when it comes to things like housing.
Okay. For the majority of the population, capital is overwhelmingly tied up in real estate. It's their home. And the return on owning a home is essentially the rent you avoid paying, which Piketty estimates can yield a real return of 3 to 4% a year.
So that 3 to 4% is the threshold. It's the return that lets you participate in the capital growth system.
It is. But for people with small initial fortunes, say under 100 or 200,000 euros, just getting that down payment to access that 3 to 4% return is incredibly difficult, especially in big cities where prices are prohibitive.
And this creates what you call the tenant trap.
Exactly. If you remain a tenant, you have to pay substantial rent, which of course yields a high return to your landlord, the capital owner. Meanwhile, your own modest savings are probably in a low-yield bank account, barely keeping up with inflation.
So you're effectively paying the rent to someone else while your own capital grows at basically zero, reinforcing the inequality.
Across generations, access to housing becomes a key mechanism for the structural reproduction of wealth, and then on top of that, you have to account for asset volatility.
Right, because while the long-term RG trend is relentless, in the short term, prices go all over the place.
They're notoriously volatile. We saw it with the Japanese property bubble in 1990. Private wealth shot up, then crashed, then stabilized. This short-term noise makes it hard to see the underlying trend, and it makes the system feel unpredictable even when its long-term direction is almost certain.
The fate of the minimum wage is another powerful, concrete example of how political choices shape this system.
It's a perfect institutional illustration.
Yeah.
The U.S. basically abandoned using the minimum wage as a tool to lift lower-end wages starting in the 1970s. Its real value stagnated, which directly contributed to the expansion of wage inequality.
Whereas France went the other way.
France, in direct contrast, used the minimum wage aggressively between 1968 and 1983 to compress wage hierarchies. It was a deliberate political choice aimed at reducing the pay gap. And the historical comparison shows that those kinds of choices about labor market regulation have a direct and powerful effect on the bottom half of the wage distribution.
And what about the long-standing cultural myth of American exceptionalism? The idea that the U.S. has uniquely high social mobility compared to old sclerotic Europe.
The data is really challenging that perception. Piketty's analysis suggests that the intergenerational reproduction of social class has been and remains lower in the U.S. than in many European countries.
So it's actually harder to move up the ladder in the U.S.
The Nordic countries consistently show the highest rates of mobility. The U.S., by contrast, shows a high degree of intergenerational rigidity, directly contradicting the myth. This suggests the U.S. is structurally cementing inequality, risking becoming the old Europe of the 21st century.
And even systems designed for equality, like free higher education, struggle against these forces.
They do. Even with free higher education, as they have in France, subtle mechanisms of social and cultural selection are still powerful. The data shows that students at elite institutions like Sciences Po come disproportionately from families in the top 10% of the income hierarchy.
So public spending on education, which is supposed to be an equalizer, ends up disproportionately benefiting the kids who are already the most advantaged.
It can, because they are better prepared culturally and financially to access those elite institutions in the first place.
Now let's scale this all the way up to the global level. What about the super wealthy?
The Forbes rankings, for all their imperfections, show the relentless power of RG on a massive scale. The world's largest fortunes grew at a real rate of 6 to 7% annually between 1987 and 2013.
Which is significantly faster than average global growth of maybe 3 or 4%.
Much faster. And the comparison between an heiress and an entrepreneur is the perfect illustration of why this mechanism is independent of individual effort.
This is the Lillian Bettencourt and Bill Gates example.
It is. Lillian Bettencourt, the L'Oreal heiress who, quote, never worked a day in her life, saw her fortune grow at the exact same 13% nominal annual rate between 1990 and 2010 as Bill Gates, the high-tech pioneer.
That's a devastating critique of the meritocratic defense of billionaires.
It is. It shows that once a fortune passes a certain threshold, its accumulation has a self-perpetuating dynamic that is completely independent of the initial entrepreneurial effort. It's the sheer size of the capital that matter.
Finally, looking ahead, Piketty introduces the critical role of sovereign wealth funds.
Yes, these funds, mostly driven by oil money, are a huge new factor. In 2013, they totaled about $5.3 trillion, which was comparable to the total wealth of all Forbes billionaires combined.
And what's the critical difference between a private billionaire and a sovereign wealth fund?
The sovereign wealth fund grows not just by reinvesting its returns, but also by investing a continuous, massive inflow of cash from oil sales, what Piketty calls petroleum rent.
So this inflow can actually outweigh the investment returns themselves.
It can. And the implication for global capital is stark. If oil prices stay high and that rent is fully invested, Piketty says there's no economic law that rules out a scenario where these funds could own 10, 20%, or even more of total global capital by 2030 or 2040.
Which would create a whole new form of global divergence.
A new form where oil states, through their state-backed funds, could effectively accumulate massive claims on the assets of the rest of the planet, especially the slow-growing Western economies. It completely reshuffles the political map of capital ownership.
The central theme here, then, is that Piketty forces us to see economic history not as a collection of individual choices, but as a system.
A profoundly political system, not just an economic one. He shows that economic and political changes are inextricably intertwined.
The big shift toward equality between 1914 and 1950 wasn't a choice. It was a product of war, and the policies made to cope with war. It took that level of chaos to compress the hierarchy.
Which means that genuine structural change today would require either similar chaos, which nobody wants, or a comparable level of political force and sustained democratic pressure.
And this systemic view really reveals the inadequacy of individual effort when it's up against these structural forces.
The 19th century world of Balzac and Austin provides the perfect historical lab. Even the top earners of that day, a highly respected judge, a prominent physician, people at the very pinnacle of labor income, could not achieve the same standard of living as the wealthiest 1% of heirs.
Who could afford a staff of 25 or 30 servants?
A symbol of economic dominion that labor income simply could not buy. Labor income cannot structurally compete with inherited capital when R is greater than G.
And what sustains this unequal system today is the systemic problem of financial opacity.
The lack of transparency. The lack of clear public data on corporate accounting and global tax flows makes democratic oversight of capitalism incredibly difficult. This opacity ensures that policies often fail to serve the interests of the least well-off, because policymakers literally cannot see the full extent of wealth accumulation and tax avoidance.
Piketty's data also systematically challenges some of our most deeply held cultural myths.
It does. Take the illusion of the French Revolution. The revolution established legal equality and abolished feudal privileges, all with the optimistic belief that in a free market, fortunes would naturally tend toward equality over time.
But the data shows the opposite happened.
Exactly. Wealth concentration continued to increase steadily throughout the 19th century, peaking in the Belle Epoque at extreme levels. It proves empirically that equality of rights in the marketplace is not enough to ensure equality of rights, period. The free market, left to its own devices in a low-growth world, defaults to high concentration.
And this leads to what is maybe the hardest cultural pill to swallow. The inequality from RG is not caused by market imperfections.
It is not a flaw in the system. It is a feature of a pure and perfect capital market. When capital is privately owned and growth is slow, the market efficiently rewards capital at a rate, R, that structurally outpaces income growth, G.
So we can't just blame a greedy banker or a lazy rentier. The system is logically sound, according to its own rules.
The logical contradiction that capital yields income without labor is a fundamental reality of the system, and the anxiety we feel comes from the fact that this structural inequality often feels inevitable, suggesting that only powerful external political forces can counteract the natural gravitational pull of accumulation.
So after all this, what does Piketty's comprehensive, data-driven exploration really help us see that is normally hidden by short-term noise or our own cultural myths?
It reveals that long-term self-perpetuating mechanism of RG. This structural force acts slowly over generations, so it's easily obscured, but its effect is persistent and, in a low-growth world, inevitable.
So it's a historical and mathematical rebuttal to the belief that economic progress just naturally leads to greater equality.
Exactly. The key takeaway is that we have to view inequality as a system dynamic, a dynamic where wealth accumulation naturally outpaces economic output, leading structurally back towards a patrimonial capitalism, where the economic weight of the past devours the future potential of labor.
Which raises these profound, unresolved questions for fairness and democracy in our century. First, the system's challenge. What non-apocalyptic solutions even exist for addressing RG? We can't rely on high growth forever, and we can't rely on another world war.
And then there's the question of the state and its debt. Piketty argues that an exceptional, globally coordinated, progressive tax on private capital is the most just and efficient solution for reducing the massive public debts of wealthy nations. He compares it to the crude tool of inflation, which punishes everyone indiscriminately, or the injustice of prolonged austerity, which has been Europe's choice.
And finally, there's the political problem of democratic reinvention. How can we achieve global economic democracy and transparency when our own institutions, like the European Union, are hamstrung by tax competition between member states and political fragmentation?
The difficulty that individual nation-states face in trying to regulate mobile, globalized capital is one of the most pressing issues for democratic sovereignty today.
I think the history of progressive taxation suggests a really sobering final thought.
It does. That without a radical shock like a war or some kind of sustained, concerted democratic pressure, the current equilibrium, where the new world of the Americas risks becoming the old Europe of the 21st century, dominated by inherited wealth and passive accumulation, that equilibrium is likely to persist indefinitely.
This has been a deep dive into the monumental work, Capital in the 21st Century. It is dense, it's data-heavy, but it's absolutely essential reading for understanding the structural forces at play in our world today.
We strongly encourage you to read the book yourself, support Thomas Piketty, or check your local library.
For shorter, visual overview of this topic, see the mini-explainer linked in the description. If you enjoy systems-level analysis like this, please like, subscribe, and comment with books or topics you'd like us to explore next.